Somewhere in America right now, a recently retired couple is staring at a brokerage account they spent 20 years building. They did everything the financial world told them to do. They saved steadily, they bought index funds, they stayed invested through crashes, they ignored the noise, they let time do its work. And now finally they are ready to use that money. But there is a problem. They believe that the moment they start selling those investments, the IRS automatically steps in and takes a cut. So they hesitate, they delay. They tell themselves they'll figure it out later. And in doing that, many retirees miss one of the most valuable tax windows they will ever have in their entire financial life. A window where appreciated investments can potentially be sold at a 0% federal long-term capital gains rate. Not deferred, not hidden, not pushed into the future. Zero. Most people never hear this explained clearly because most financial conversations around retirement are built around one question. How much have you saved? But retirement is not just about how much you saved, it is about how you take it out. Because the difference between a well-funded retirement and a tax-efficient retirement can be tens of thousands of dollars, sometimes more. And the tragedy is this: a lot of retirees do not overpay because they were reckless. They overpay because no one ever sat them down and showed them how the early years of retirement can create a tax environment they may never see again. A lower income period, a planning window, a chance to sell gains, reset cost basis, clean up future tax exposure, and do it while the federal tax rate on those gains is sitting at zero. In this video, we are going to break down exactly how that works. We'll cover what the 0% capital gains bracket actually is, why retirement creates the perfect conditions for it, how tax gain harvesting works, how it differs from tax loss harvesting, and how this one strategy can fit into a bigger retirement income plan that protects more of what you spent a lifetime building. Because once you see this clearly, you will never look at retirement withdrawals the same way again. Most Americans carry a simple assumption into retirement. If you sell investments at a profit, you owe tax. That sounds reasonable, it sounds responsible, it sounds like common sense. And in many cases, it is true. But common sense and tax law are not always the same thing. Here is what most people never slow down long enough to understand. Tax you pay on investments depends not only on the gain itself, but also on the income context surrounding that gain. That changes everything. During your working years, you may have a salary, bonuses, business income, perhaps even rental income, or required account distributions layered on top. That extra income fills up your tax picture. By the time you sell appreciated investments, you are often already sitting in a range where long-term capital gains are taxed at 15% and sometimes higher, so people internalize the rule. Sell gains, pay tax, then retirement arrives, the paycheck stops. W-2 income disappears. In some cases, Social Security has not started yet. Required minimum distributions have not started yet either. And suddenly, a household that looked middle or upper middle income on paper for decades may have a surprisingly low taxable income for several years. That is not a minor technicality. That is an opportunity, because the federal tax code does not ask whether you are retired. It asks what your taxable income is. And when that taxable income is low enough, your long-term capital gains can fall into the 0% bracket, which means the gain is real, the sale is real, the money is real. But the federal tax bill on that gain can be zero. That is the part people miss. They think retirement is the moment taxes become unavoidable. In many cases, it is actually the moment when strategic tax planning becomes more powerful than it has ever been before. And if you let that window pass without using it, you may spend the next decade paying taxes on gains you could have locked in at zero. Not because the law changed, not because the strategy was illegal, but because nobody showed you the window while it was open. Let's make this practical. When you sell an investment you have held for more than 1 year, the profit is generally treated as a long-term capital gain. That profit is not taxed the same way as ordinary income. It has its own set of rates, and one of those rates is 0%. For many retirees, that sounds almost impossible, but it is not. What matters is not just the gain itself. What matters is how that gain fits into your overall taxable income picture. That is where people get confused. They hear a threshold and assume it could never apply to them. But taxable income is not the same thing as gross income. Deductions matter. The standard deduction matters. The type of income matters. The timing of Social Security matters. Whether you are drawing from taxable accounts, Roth accounts, or traditional retirement accounts matters. So here is the concept to understand. If your taxable income sits inside the lower range, then your long-term capital gains can be taxed at 0% federally. That does not mean every retiree automatically qualifies. It does not mean state taxes disappear. And it does not mean you can ignore the rest of your tax picture. But it does mean that many retirees are far closer to this opportunity than they realize, especially in the years between leaving work and fully turning on every other income stream. This is why retirement tax planning is not just about minimizing taxes this year. It is about deciding which years are best for which moves. There are years to convert, years to delay, years to harvest gains, years to lean on cash, years to use Roth dollars, years to hold back. And one of the smartest years for harvesting gains may be a year that looks on the surface like nothing special at all. A year with lower taxable income, a year with no paycheck, a year before required minimum distributions begin, a year where your investments are up but your tax return is quiet. That quiet tax return can be worth a lot of money if you know what to do with it. Think about the average retiree's timeline. For decades, life follows a pretty predictable financial rhythm. You work, You earn, you save, you invest, you file taxes around a relatively stable income pattern. Then one day that rhythm changes, the salary disappears, the commute ends, the retirement date arrives. And for the first time in years, maybe decades, your earned income drops dramatically. Now, if you start Social Security right away, that becomes part of the picture. If you have pension income, that becomes part of the picture. If you are already at the age where required minimum distributions apply, that becomes part of the picture too. But many retirees have a gap, a stretch of years where income is lower than it used to be, but the investment assets are larger than they have ever been. That combination is rare. Low taxable income, high embedded gains. That is exactly what makes the 0% capital gains window so powerful. Imagine a married couple who retire at 62. They delay Social Security. They are not yet forced into large IRA withdrawals. They have a taxable brokerage account full of index funds they bought 15 years ago. Their gains are real. But their taxable income for the year may be far lower than it was while they were working. That is not just a lifestyle transition, that is a planning opportunity. Because if they ignore that window, the gains stay embedded, the old low-cost basis stays in place. And later, when Social Security begins or required distributions kick in or other income rises, those same gains may now be sold in a less favorable tax environment. Same investments. Same household, different tax outcome. Why? Because they failed to use time as a planning tool. This is one of the most important mindset shifts in retirement. You are not just withdrawing money. You are managing tax years. Some years are expensive. Some years are unusually cheap. The retirees who understand this do not just ask, how much money do we need? They ask, what kind of income does this year allow us to create at the lowest possible tax cost? That question changes everything. Now let's talk about the actual move. It is called tax gain harvesting. And despite how rarely it gets discussed outside of advanced planning circles, the idea is not complicated. If you are in a year where your long-term capital gains fall into the 0% federal bracket, you can sell appreciated investments, realize the gain, and potentially owe no federal capital gains tax on that gain. Then, if you still want to own the investment, you can buy it back. That last part is where the strategy becomes powerful, because when you sell and repurchase, you reset your cost basis. Your new basis becomes the new purchase price. That means the gain you just realized at 0% has effectively been cleaned out of the position, locked in, neutralized from a future federal capital gains perspective. Now compare that to doing nothing. If you never harvest the gain, the old low basis stays with you. The built-in tax exposure keeps growing. And years later, if you need to sell during a higher income year, you may pay 15% more on gains that could have been realized earlier at 0%. That is why this is not just about saving tax today. It is about reducing tax drag tomorrow. And there is another detail here that confuses people. They hear about tax loss harvesting and assume the same restrictions must apply. But the famous wash sale rule applies to losses, not gains. If you sell something at a loss and buy it right back, the IRS has rules that can disallow that loss. But with gains, that is not the issue. If you sell appreciated shares and buy the same investment back after realizing the gain, you are generally not violating a wash sale rule because you harvested a gain, not a loss. That is what makes the strategy so useful. You are not necessarily changing your investment allocation. You are not abandoning the asset. You are not making a market timing bet. You are improving the tax foundation of what you already own. In simple English, you are saying, I want to keep owning this investment. I just do not want to keep carrying around an old, deeply appreciated tax problem if I can reset it to zero. That is smart retirement planning. Not flashy, not exotic, just smart. Let's walk through a clean example. Suppose a retired married couple has a taxable brokerage account with an index fund position worth $180,000. Their original cost basis in that position is $100,000. So embedded inside that holding is an $80,000 long-term capital gain. Now let's assume this is one of their lower income years. Maybe they retired recently. Maybe Social Security has not started yet. Maybe they are living partly on cash savings and some Roth withdrawals. Their taxable income remains low enough that a large portion of that $80,000 gain can fall inside the 0% long-term capital gains bracket. So they sell the position, they realize the gain. And because of the way their tax picture is structured that year, the federal tax on that gain may be zero. Then they turn around and buy the same fund again. Now what changed? The investment exposure may be basically the same. They still own the fund. They still participate in future market growth. But their cost basis is no longer $100,000. It is now closer to the new purchase price. That means the old embedded gain has been reset. Future taxes, if and when they apply, start from a much higher floor. That matters. Because retirement is not one sale, it is a series of decisions made over years. And each time you improve basis in a favorable year, you make future flexibility better. Maybe years later they need cash for a home repair. Maybe a health event changes expenses. Maybe one spouse dies and filing status changes. Maybe later sales happen in a more compressed tax environment. If basis has been reset along the way, those future decisions are less expensive. This is one of the hidden advantages of tax gain harvesting. It improves the retirement you have not lived yet. It is not only a tax move, it is a future optionality move. And in retirement, flexibility is often just as valuable as return. If this strategy is legal, logical, and potentially valuable, why do so few retirees use it? Because most people were never taught to think this way. During the accumulation phase of life, the message is simple. Save more, invest more, do not touch it, let it grow. That is good advice for building wealth. But decumulation is different. Retirement is not just accumulation in reverse. It is distribution with consequences. And the skills needed there are different. You need to understand sequencing, tax character, bracket management, Social Security timing, Medicare interactions, required distributions, Roth withdrawals, brokerage withdrawals, capital gains. Income stacking. Most people do not get taught that. Their accountant may be excellent at preparing returns, but not focused on long-range withdrawal strategy. Their investment advisor may be strong on portfolio management, but less focused on year-by-year tax choreography. And the retiree assumes that if something this useful existed, somebody surely would have mentioned it. That assumption is expensive, because the tax code does not send reminders. The IRS does not call retirees and say, you appear to be in a low-income year. Would you like to realize gains at 0% and reset your cost basis while you still can? Of course not. You have to know the move exists. Then you have to see the year clearly enough to use it. That is why awareness matters so much here. Not hype, awareness. Once you understand the concept, you start seeing retirement years differently. You stop viewing all taxable sales as equal. You stop assuming every gain is automatically expensive. You stop thinking only in terms of annual return. And you start asking the question wealthy, tax-aware retirees ask, is this one of the years where I can improve my future tax position at very low cost? That question is where better retirement planning begins. Now, this is where the strategy gets more nuanced, because a tax move is only smart if it fits the larger picture. A retiree may have years where Roth withdrawals help keep taxable income lower, years where Social Security has not yet started, years where traditional IRA withdrawals are intentionally modest, years where there is room to harvest gains without triggering higher taxes elsewhere. That is the sweet spot. And this is also where retirement finance becomes more than just picking good investments. A good portfolio matters, but a good portfolio with bad withdrawal timing can still create avoidable taxes. Meanwhile, a solid, boring portfolio paired with smart tax sequencing can quietly outperform in the only place that matters: net spendable money. The money you actually keep. The money that supports your life. The money that determines whether retirement feels constrained or comfortable. So when you hear someone say, I do not worry about tax strategy, I just let my advisor handle the investments, understand what they may be missing. Returns matter, but after-tax returns matter more. And in retirement, the order and type of withdrawals can matter just as much as market performance. The deeper lesson here is not just about one bracket. It is about seeing retirement as a series of windows. There are windows for Roth conversions, windows for delaying Social Security, windows for reducing future required distributions, windows for gifting, windows for harvesting gains, and windows close. That is what makes this so important. The 0% capital gains bracket is not valuable because it is mysterious. It is valuable because it often appears at precisely the moment people are least prepared to use it, right after they stop working, right when life is changing, right when the financial conversation is dominated by fear, uncertainty, and the question of whether the money will last. That is exactly when many retirees become too conservative in the wrong way. They avoid action, they avoid strategic sales, they avoid planning moves that could improve the next 10 years. And in trying not to make a mistake, they let an opportunity expire. So let me say this clearly. Retirement tax planning is not about gaming the system. It is about understanding the system well enough to stop donating money you did not actually owe. That is not aggressive. That is not shady. That is not a loophole. That is stewardship. You spent years building your assets. You took market risk. You delayed gratification. You made sacrifices. You do not owe it to anyone to be careless in the distribution phase. If the law gives you a year where gains can be realized at 0%, that year deserves attention. Because once later income fills up the return, that same move may cost more. And retirement has enough uncertainty already. When you get a clean window, you use it. So here is the takeaway. If you are retired or close to retirement and you own appreciated investments in a taxable brokerage account, do not assume every sale is automatically a tax mistake. Look at the year. Look at the income picture. Look at what has stopped. Look at what has not started yet. Look at how much room may exist beneath the capital gains thresholds. Because one of the most overlooked opportunities in retirement is not earning more. It is structuring what you already have more intelligently. A well-timed gain harvested at 0% can do more than save tax this year. It can reset cost basis, reduce future tax exposure, increase flexibility, and make the rest of retirement planning easier. That is not theory. That is not internet folklore. That is how the rules work when you understand the calendar, the brackets, and the difference between gross wealth and after-tax wealth. And for many retirees, that difference is everything. If this is the kind of retirement strategy content you want more of, subscribe Buffett Mindset. Because in the next videos, we'll cover the retirement tax window most people miss, how Roth withdrawals can change your income picture, and the mistakes that quietly push retirees into higher tax costs without them realizing it. Your retirement is not just about what you own, it is about what you keep. And the people who understand that are usually the people who retire with more confidence, more flexibility, and a lot less regret.